The topic of today's video is why Warren Buffett and Charlie Munger do not sell investments. And I think there's sort of a few main reasons behind this, and we'll get into that in a sec. But first, I think it's best that we kick it off with the man himself, Charlie Munger, to explain his kind of viewpoint on why they no longer sell stocks.
If you stick with stocks that can't possibly be wonderful to just put away in your safe deposit box for 40 years, but are underpriced, then you have to keep moving around all the time. As they get closer to what you think the real value is, you have to sell them and then find others. And so it's an active kind of investing. The investing where you find a few great companies and just sit on your ass because you've correctly predicted the future, that is what it's very nice to be good at.
The movie was G-rated, even though...
So there you have it. That's why Charlie Munger and Warren Buffett don't sell great companies. Great companies grow over the long term. They compound wealth at amazing rates. And you really don't have to do anything but sit on your ass, in the words of Charlie Munger. But what I want to get to, I want to dive a little bit deeper into this, because what you have to think about with Berkshire Hathaway and Warren Buffett / Charlie Munger is that there were really sort of two phases through their investment career. In the early days, they were very active. They were buying and selling a lot of companies. And in their later days, so the modern Berkshire Hathaway, once they invest into a company and buy shares in a company or buy a private business, they really don't sell it for the reasons that Charlie's just mentioned, but for a couple of reasons, a couple of other reasons as well that didn't affect them so much before. So the first big reason is around size. So Warren Buffett and Charlie Munger are very negative, I guess, when it comes to diversification. So they want to put the most money they possibly can into their best ideas. And what that means is, in practice, when they go out and buy shares in a company, they typically buy up a pretty substantial chunk of it. So in the case of Coca-Cola, they initially bought around 6 or 7% of the company. Through share buybacks, over time, they're now up to about a 9% or so ownership in Coca-Cola. Same goes for Apple. They've been buying Apple quite aggressively over the last 2 years or so, and they now own about 5% of Apple stock. And even if they never buy another share of Apple again, that ownership percentage will continue to go up because Apple is constantly repurchasing shares. And that comes along with a couple of negatives in terms of liquidity. So what I mean by liquidity is essentially the ability of investors to get in and out of investments without having any significant impact on the price. So what happens in the case of someone like myself, where I own a relatively minor number of shares, I can get in and out of companies in probably about 10 seconds. That's not exaggerating at all. As soon as I kind of click buy or click sell on a trade and put that order in, I can get in and out of that company quite quick, assuming that I'm not trying to buy at a price a lot lower than it's currently trading, or sell a lot higher than it's currently trading, or anything like that. Assuming I'm buying and selling at just market price, I can get in and out quite quickly. So that's me. Warren Buffett and Berkshire Hathaway, if they want to sell out of an investment, or if they want to buy into an investment, that's going to take years. So like I said before, they've been buying Apple over about a 2-year period. There's some downsides with that. There's some big downsides with that. So during the period from sort of the first purchase of Apple stock through to the most recent purchase of Apple stock, the price of Apple shares went up around 40%. They went up about 40% from the initial purchase to the most recent purchase. And there's a few reasons behind that. So first off, since Warren is trying to buy so many shares of Apple in this case, that puts a lot of upward kind of buying pressure on the stock. When there's a lot of upward buying pressure and there's not a huge amount of selling pressure, prices just go up. That's supply and demand. It's just the way things work. So we're up about 40%. If I was buying Apple at the same time as Warren Buffett, I would have been able to get all the shares I possibly wanted about 40% cheaper than Warren Buffett was still buying shares at his later stage. So we see that size has a massive impact on returns, especially when you're not a fan of diversifying and you're buying intensively into an individual company. So the exact same thing happens with selling, and that's the reason why Warren Buffett has chosen to hold on to Coca-Cola for all these years. He's never going to sell Coca-Cola. He's probably never going to sell Apple either, just because of sheer size. So that's reason number one why they don't sell. Let's get into reason number two. Reason number two is tax. So when you buy into shares of a company, in most countries at least, fortunately this one doesn't apply to me here in New Zealand, which is fantastic, but it does apply if I invest overseas. So if I invest in the US or in Australia or outside of my own country, there are going to be tax implications every time I sell a company, assuming that I've made a profit on that investment. So capital gains tax is what I'm talking about here. So capital gains, again, it's going to depend on the country you live in and the country you're investing in, but every time you sell a company at a profit, you're going to have to pay tax on those gains. So in the case of the most extreme example there is, which would be probably Berkshire Hathaway itself, Berkshire.A is the ticker on that one. So Buffett started buying Berkshire Hathaway at about, off the top of my head, it was about $7 a share. If you know anything about what the current Berkshire Hathaway stock price is, you'll know that $7 is ridiculous. The current share price is about $315,000. So when you go to pay capital gains tax on an enormous gain like that, basically you're going to lose a huge chunk of your position. So if the capital gains tax rate is, let's call it 20%, then pretty much all of that figure is capital gain. 315,000 minus $7 is still pretty much 315,000. So if we were to sell Berkshire Hathaway shares that we bought, in the 50s or 60s when it was at $7, we're going to have to pay about 20% of that in tax. We're going to have an instant 20% loss in our sort of mark-to-market price of our investments, and that's another reason why Warren Buffett and Charlie Munger tend to stick with their investments long term. They don't want to have that big capital gains hit. They picked up these good companies at fantastic prices. Those companies are throwing dividends at them, every quarter or every year, and they're more than happy to just sit there and accept those dividends and watch them grow over time. So that's number two. Let's get into reason number three, and the final reason why Buffett and Munger don't sell investments. So the final reason is that great companies compound money naturally. So great companies compound. So in the early days, and you might already be familiar with the story, but in the early days, Buffett and Munger would invest in what's called cigarette butt investments, or in other words, investments that are really bad companies, but they've got one or two puffs in them. They're basically free. There's cigarette butts just lying on the ground. And in practice, what that means is that they could buy into a company for less than the cash and assets that company had. So, in other words, if you were to sell everything off that the company owns, if you were to pay all the debts, then what's left plus any cash that company has in its bank accounts, if you were to distribute that out to shareholders, that would be more than you currently have to pay per share for that company. So those were the cigar butt investments. They were typically terrible companies. You couldn't do this at a very large scale. Like I said earlier on, Buffett and Munger love to pour massive amounts of money into their best ideas, and you really just can't do that at scale. So what happened is when Warren Buffett met Charlie Munger, Munger actually helped him to change his philosophy on investments. The cigar butt method just wasn't scalable. It wasn't something you could do with billions and billions of dollars like they're investing now. So that left them with great companies as their sort of best option to invest in. So we're going to have to pay up a little bit more for these great companies, but there's a couple of phenomenal benefits. And you heard Charlie talk about it at the start of the video, and that is that great companies just continue to grow, continue to throw off cash and compound your money over time. And you know, Charlie Munger is a guy that basically never has a transaction anymore. He's very inactive as an investor. He picks great companies infrequently and puts a lot of money into them when they do come up. But outside of that, he really does nothing. And he continues to beat the market year after year after year by just sitting and holding about 3 stocks. Today he owns Costco, he owns Berkshire Hathaway, and he owns the Daily Journal stock, and he has some investments with Li Lu, who invests his money in China for Charlie. So he really only has about 4 holdings. Within a couple of those holdings, there's a lot of diversification. So in Berkshire Hathaway, for example, they own about 70 businesses all up. But really, he's very concentrated in his investments. He doesn't have a lot of picks, and he's not active. He's confident that those companies will grow vastly over time. They'll be much more valuable than they are today. So, you know, what are the chances that Berkshire Hathaway is going to fail? What are the chances that Costco is going to fail? What are the chances that Li Lu is going to fail over in China? They're very minimal. Those companies are going to continue to compound wealth over time. They have very high return on equity and very high return on invested capital. You've heard me talk about those numbers a couple of times now. Those are the key figures that mean we're going to get a very high internal return within those businesses, and it's going to compound wealth quite aggressively over time. So those are the 3 reasons why Buffett and Munger don't sell investments. They definitely did in the earlier days when they were more active in buying the cigar butt type investments, but they don't now. And if you're buying great companies at fantastic prices when they do come up, you probably shouldn't be selling them either. There's a lot of frictional costs that can kind of eat at your returns over time with that. So hope you enjoyed the video. I'm keen to hear your thoughts. Do you agree? Do you disagree? Do you have any things that maybe didn't quite make sense, or any other questions you have? Let me know in the comments below. But that's all from me today. Be sure to hit subscribe over here somewhere and watch some other videos over here. So I will see you in the next one. Cheers.